On March 31st, the valuation of the Nifty 50 index got cheaper by almost 18%. Yes, 18%. And what's remarkable is that this change happened without the market actually falling. Confused? Then hang around because in this video we shall discuss what happened that led to the Nifty PE ratio falling by 18%, why it happened, and most importantly, what are the implications to you as an investor. Let's begin with what happened. The Nifty 50 is India's most popular stock market index and serves as a benchmark to many mutual funds and financial products. The index values are calculated daily on the basis of a clear set of rules and a methodology which is publicly available. On 24th of February, the National Stock Exchange or NSE announced in a press release that effective March 31st, there will be a small yet significant change in the Nifty 50's index management methodology. Under the new system, the Nifty PE ratio shall be calculated on the basis of the consolidated earnings of the Nifty 50 companies and not against the standalone numbers, which was the practice for many years. So to put it in a formula, the NSE computes the Nifty 50 P ratio as the total free float market capitalization of all Nifty 50 companies divided by the total free float profit after tax of the trailing 4 quarters. Which means while there is no change in the numerator, the denominator will now consider the rolling 4 quarters of consolidated earnings instead of the standalone earnings. Now you might have come across these two terms, standalone and consolidated earnings. When we say consolidated numbers, it means the aggregated reporting of a firm's entire business, including its subsidiaries. For example, in its most simplified definition, Tata Motors is an Indian automobile manufacturing company. But to conduct this business, Tata Motors has created dozens of other companies, some listed but most of them unlisted, which then individually support their joint ventures, technology platforms, insurance broking arm, export units, ancillary units, and much more. Tata Motors also has a major global presence with subsidiaries in many countries around the world, with none bigger than the Jaguar Land Rover Limited, which contributes a major portion of the group's revenue. An examination of the last 4 quarters shows that while the standalone profits of Tata Motors look better in some quarters, it is definitely not the case all the time as different parts of the group go through different sales, profit and capex cycles. But overall, we see that Tata Motors shows a better trailing year net profit situation on a standalone basis rather than on a consolidated basis. More importantly, the difference between the standalone and the consolidated earnings can be quite high, as we see in the case of Tata Motors and as we see in some other large cap companies like Bharti Airtel, State Bank of India, Reliance Industries, etc., where the consolidated earnings are much higher than the standalone earnings. In fact, a recent analysis by DSP Mutual Fund says that out of the 50 companies in the Nifty, as many as 39 companies had consolidated earnings which were higher than the standalone earnings. And it is only in the case of 9 companies that the consolidated earnings were lower. Which means as an aggregate, the total earnings of the Nifty 50 index have improved with the use of consolidated earnings, which is the reason why the Nifty P ratio fell by almost 18% on March 31st. A direct impact of a lower P ratio is that the Nifty valuations start looking more attractive on a historical basis. Figuratively speaking, what was a trailing P ratio of 40 for most of last month is now a relatively cheaper P ratio of 33. Which means the comparison of P ratios will now become a lot more difficult, and it's likely that many retail investors who are not aware of this change might get attracted to investing more money assuming that the earnings have organically improved. So this is something that people who invest via ETFs and index mutual funds should keep a track of. Another implication of this change pertains to some investment products whose strategies are basically built around P ratios. For example, let's say there is a fund or you yourself invest in a bundle of stocks which is built on a P ratio based value strategy. What this means is that this bundle or fund will only invest in those companies whose trailing 12-month P ratio is lower than the P ratio of the Nifty 50. As you can imagine, these funds will then have a harder time finding stocks because prior to this change, there were 31 companies in the Nifty 50 whose P ratio was less than 40. But now, with the P ratio dipping to 33, the number of companies in the selection universe has gone down by almost a third and is now down to 22 companies. The implication here is that some tweaking will be needed in the funds or your own strategy of selection if you are following a PE ratio based criteria. In fact, if you are investing in a dynamic asset allocation fund or a balance advantage fund, then do look out for some note or some communication on how these companies are changing their valuation model to suit this particular change. This step towards using consolidated earnings seems a very logical one. After all, over the last 2 decades, Indian companies have invested substantial money in units all around the world and have given them much time to operationally stabilize and build earnings. An 18% lift in earnings is adequate proof that the strategy has played out really well, and it makes much sense for it to be captured in the index calculations. From an investor's perspective, this mandatory reporting of quarterly consolidated data will be very useful as we'll now have a more realistic picture of the stock market valuations. However, it is important to note that this change in methodology is a one-time change and should not be assumed as a major opportunity or create any major roadblocks in your investment strategy. So continue with your SIPs as it was, continue with your asset allocation, be very disciplined about your investing, and use this video more as a knowledge session that prevents you from misinterpreting information that may lead to avoidable losses. And with this, we come to the end of this short and sweet video. If you think the contents of this video will help a friend, then do spread the good word by sharing this video over WhatsApp, Facebook, and Twitter. And if you have any questions for us, do send them across in the comments box below. Thank you for your time, and we look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.